Ever wondered how the stock market works and how you could participate in it? Well, you're in the right place. The stock market is a fascinating world that acts as a powerful engine of wealth creation. At its core, it's a platform where buyers and sellers come together to trade shares. These shares represent a portion of ownership in publicly traded companies. Think of it as a bustling marketplace, but instead of buying and selling goods, people are buying and selling portions of companies. When you buy a share, you're essentially buying a piece of a company, gaining a stake in its success or failure. This dynamic exchange of ownership is the lifeblood of the stock market, fueling economies and shaping the financial landscape. So, to put it simply, the stock market is like a marketplace where ownership in companies changes hands. Why should you consider investing in stocks? Well, the answer lies in the word growth. Stocks offer the potential for long-term growth that can significantly outperform other investments like bonds or savings accounts. Imagine this, your money working for you, compounding year after year. It's like planting a seed and watching it grow into a mighty tree over time. Now let's talk dividends. Some companies distribute a portion of their earnings back to shareholders in the form of dividends. So not only can your investment grow, but it can also provide you with a regular income stream. Plus, investing in stocks means owning a piece of a company. You get to participate in its successes and share in its profits. It's like being a silent partner in a business without having to manage day-to-day operations. In essence, stocks provide an opportunity for long-term growth and ownership in companies. Investing in stocks is an excellent way to build wealth over time. Did you know there are different types of stocks? Indeed, stocks are not one-size-fits-all, and understanding the differences can help shape your investment strategy. The stock market mainly offers two types of stocks, common and preferred. Let's break them down. Common stocks are probably what first comes to mind when you think of investing. Purchasing common stocks gives you a piece of ownership in a company, and usually comes with voting rights. These rights allow you to have a say in company decisions like electing the board of directors. On the other hand, preferred stocks are a bit more unique. They typically don't come with voting rights, but they do have a leg up when it comes to dividends. Preferred stockholders generally receive dividends before common stockholders, and the dividends tend to be higher. Knowing the difference between common and preferred stocks can help you make informed investment decisions. Ready to start your investment journey? It's as thrilling as it is rewarding. Here's your roadmap. First things first, you need to open a brokerage account. This is your gateway to the stock market. Many online platforms are available, each with its own unique features and tools. Choose one that aligns with your investment goals and comfort level. Next, research is your best ally. The more you know about a company, the better you can predict its future performance. Look into their financial health, competitive positioning, and industry trends. Remember, the goal is to invest in a company's future, not its past. Deciding on an investment strategy is another vital step. Are you a risk taker looking for high returns, or do you prefer a slow and steady growth? Maybe you're somewhere in between. Individual stocks, mutual funds, or exchange-traded funds. Explore these options and understand what suits you best. With the right tools and information, you can start your investment journey. Investing in stocks isn't without its risks. While the stock market can potentially offer high returns, it's not all sunshine and rainbows. There's the risk of market volatility, where share prices fluctuate wildly due to economic changes, political events, or even company-specific news. These swings can be quite stressful, especially if you're new to investing. Then there's the company-specific risk. This is when a company you've invested in faces issues that negatively impact its stock price. It could be anything from a poor earnings report to a scandal involving the CEO. The third risk is perhaps the most daunting: the risk of losing money. Yes, you heard that right. If a company goes under, shareholders can lose their entire investment. But don't let these risks scare you away. One of the best ways to mitigate them is through diversification, where you spread your investments across different industries and companies. Understanding and managing risks are key to successful investing. Ever heard of fundamental analysis? It's a key tool in an investor's toolbox. This method allows you to evaluate a company's financial health and growth potential. It involves a deep dive into a company's financial statements, scrutinizing balance sheets, income statements, and cash flow statements. You're not just looking at numbers though. You're also assessing the company's management team, their strategy, and how they handle challenges. You're looking at the company's competitive advantages, or what sets them apart in the market, and you're keeping an eye on industry trends, considering how they might impact the company's future. Think of it like doing your homework before making a major purchase. You wouldn't buy a car without checking its mileage and maintenance history, right? Similarly, fundamental analysis helps you understand the health of a company beyond just its stock price. Fundamental analysis can help you determine a company's intrinsic value. It's about making informed investments, not just relying on market trends. What about technical analysis? Well, this is a method that traders use to forecast the future direction of prices through the study of past market data, primarily price and volume. It's all about identifying patterns and trends in the stock prices to make informed decisions. Technical analysts believe that all the information they need about a stock can be found in its charts. They use various tools like bar charts, line charts, or candlestick charts to visualize price movements. Then there's the concept of moving averages, which smooth out price data to help traders better gauge the long-term direction of a stock. It's a bit like taking a step back to see the forest, not just the trees. Indicators, another key tool, provide unique insights into aspects like momentum, trends, volatility, and market strength. These are used to pinpoint potential entry and exit points for trades. In essence, technical analysis can be a valuable tool for short-term trading decisions. Are you a long-term investor or a short-term trader? That's a question that often pops up in the world of investing. Here, let's break down the differences. Long-term investing is like planting a tree and patiently waiting for it to bear fruit. It's about buying and holding stocks for several years with the goal of building wealth over time. This strategy relies on the principle of compounding and the inherent growth potential of well-managed companies. On the flip side, short-term trading is more akin to a fast-paced game of chess. It involves buying and selling stocks within a shorter time frame, often based on market trends and technical analysis. The goal here is to profit from short-term price movements. Remember, both strategies have their own merits and risks. Long-term investors may miss out on quick profits, while short-term traders face higher transaction costs and market volatility. Whether you're a long-term investor or a short-term trader, understanding your investment strategy is crucial. To wrap up, we've traveled quite a journey today. We've navigated the bustling marketplace of the stock market, where investors trade shares of publicly traded companies. We've weighed the potential rewards of stock investments against other options, while highlighting the allure of ownership and dividends. We've differentiated between the common and preferred stocks, the former offering voting rights and the latter promising higher dividends. We've marked the starting point of your investment journey, opening a brokerage account, researching, and deciding your strategy. We've also acknowledged the risks accompanying the rewards in this investment landscape. We've delved into the world of fundamental and technical analysis, two crucial tools in your investment arsenal. We've contrasted the patience of long-term investing with the agility of short-term investing. Remember, understanding the stock market, conducting thorough research, and maintaining a diversified portfolio are keys to a successful investment journey. Start investing early, stay diversified, and stick to your investment strategy for long-term success. Thanks for tuning in.